Okay, today we will continue with the um, chapter 22, capital budgeting. Today's agenda is I will show finance diamond and I will explain capital budgeting, net present value, internal rate of return, and we will solve some problems and wrap up. As you remember, we have a look at the toolbox, and now um, we have discovered decision toolbox in finance, and we already covered the cost benefit analysis and cost of capital in chapter 21. Now we are looking at capital budgeting, um, and we will learn net present value and internal rate of return calculations. So what is capital budgeting? The process of investing in plant and equipment is essentially the same as for investing in securities. In chapter 13, which is bond pricing and yields, the current value of a bond was determined by discounting the future interest payments and principal repayment by the yield on comparable debt instruments. In chapter 11, which is stock valuation, future dividends payments and the growth in the firm's dividend were discounted back to the present by the required return to determine the value of stock. So both models are illustrations of discounted cash flows. Future cash inflows are discounted back to the present and compared with the cost necessary to make the investment. So an investment in plant and equipment is conceptually no different than investment in a stock or bond. In this chapter, we're looking at investments in plant and equipment. So investments in plant and equipment requires management to estimate future cash inflows, discount them back to the present at the firm's cost of capital, and compare the present value with the cost of making the investment. So what is capital budgeting? This is the process of determining the value of investment in plant and equipment and selecting among various long-term investments, um, um, which is referred to as capital budgeting. So in sum, we can say capital budgeting is the process of selecting long-term investments, primarily plant equipment. What is net present value? It is the present value of cash inflows minus cash outflows, and the discounts the cash inflows at the cost of capital and subtract the present value of the cash outflow. So if we have net present value positive, we accept the project. If net present value is less than zero, we reject the project. So let's see the main equation. So net present value is the present value of all benefits minus the present value of costs. So if this difference is greater than zero, we accept the project. If this is less than zero, we reject the project. So all we are doing here is that we have some cash flows discounted by the cost of capital, and we subtract the present discounted cash flows by the present value of cost. So ranking rule is if you have mutually exclusive projects, pick the one with the highest NPV projects. In other words, if you have project A, B, and C, and the net present value of each project is 10, 20, 30, of course you will select the highest NPV projects. So let's solve this problem. After saving 1500, you are about to buy 42-inch plasma TV. You notice that the store is offering 1 year, same as cash deal. You can take the TV today and pay nothing, which is very cool, until 1 year from now. So when you will off the store 1500 purchase price. If your saving account is 5%, what is the NPV? So the question simply says you have 1500 in your pocket, and there's a deal. You can buy a 42-inch plasma TV without paying nothing, and you will off the store and you will pay 1500 cash in 1 year. How can we solve this problem? An interest rate for your saving account is 5%. Okay, so we have NPV equation. What is the benefit for today? I just pick up the TV, and the value of the TV is 1500. I pay nothing. This is the present value of benefit, right? And I will pay I pay 1,500 in 1 year, but we need to discount this 1,500 today. Discount the value of our the cost today. So what is the in 1 year we will pay 1,500. We will pay 1,500, but we need to discount this plus k1 over power of 1 and find the net present value. So this is present value of benefit. This is present value of cost. So the K is the interest saving account. We can discount by using 5%. So what is the NPV? Let's find. So today the present value of the benefit is 1,500, and in 1 year we will pay 1,500. So we simply discount this cash outflow today and find the value of this 1,500 amount worth of 1,428.57 for today, right? So when we subtract two calculations, we find 71.43 net present value. In other words, we can say I don't pay today, I don't pay nothing today, and just pick up the TV, and I owe 1,500 in 1 year. Instead of giving 1,500 right now, I can take this money because I have the cash in my pocket. I just put on this. I would just deposit this amount in my saving account. I can earn or let's say you can say we can explain in that way. We owe 1,500. We owe 1,500, and what is the value of 1,500 today? And you can figure out the value of 1,500 in 1 year. The value of the 1,500 for today is only 1,428. Okay. So take it or leave it decision. A fertilizer company can create a new environmental friendly fertilizer at a large savings over the company's existing fertilizer. The fertilizer will require a new factory that can be built at cost of 81.6 million. Estimated return on fertilizer will 28 million in the first year and last 4 years. Okay, if the company cost of capital is 10%, should the company undertake the investment? Okay, first look at the cash flows, cash inflow, and cash outflow. What is the cash outflow? We invest. The question says the fertilizer company invests, can build a cost of 81.6, which is today. Okay, cash outflow, which is negative. Cash inflow is for time 1, 28, 28, 28, 28. So how can we find net present value? So what was net present value? Is the present value of benefits minus present value of cost. So we had the present value of benefit is 81, and present value of cash flow 28 for each year. So we need to find discounted cash flows for today, present value, right? Yeah. Estimated return on the return So we need to find present value of each cash flows and whether we check whether the net present value is positive or negative. So when we find the net present value of cash flows, we will see we can use easily. This is the present value of an YouTube formula, which you can find the selected ratios and definitions on Blackboard. But we will be using the financial calculator. So this is 28 payments present value of annuity, which is payments over cost of capital 1 minus 1 over 1 plus cost of capital over n, power of n, right? So we have cost of capital is 10, I guess. Yes. What was the, 10%. So simply we will just apply 10% here and 10% here, and 28 is the payments for each year. This is the present value of the cost, and you will find NPV. This is the hardest way because you need to put all values in this formula and find the NPV. And the easiest way is you will use your financial calculator. So how can we solve this problem? Just take your financial calculator and use the cash flow function, and when you enter the cash flow, so you will have cash flow of 0, cash flow of 1, cash flow of 2, cash flow of 3, cash flow of 4. In cash flow 0, you should enter negative 81.6. Cash flow 1 is 28, 28, 28, and 28 cash flow, and then you should push the NPV and PV button in your financial calculator, and then you will see the interest rate. Just the entered interest rate is 10. Enter, and then you use the down arrow and find the NPV, and just push the compute button and then NPV button, and you will find the NPV is 7.1562. That means this is positive and NPV is positive, so we accept the project. So what is the IRR? When you look at the discount rate, if the discount rate is 10, which is the rate that we use in our previous example, we find NPV is 7.2. What if the question gave us 12% cost of capital, and then we should find 3.4. What if question gave us the cost of capital is 14%? We will have net present value is 0. So meaning that if the cost of capital is getting lower and lower, NPV is getting higher and higher. If cost of capital is getting higher and higher, we receive negative NPV, positive NPV. So there should be some point that we have 0 NPV. So 0 NPV, the point or the rate, discount rate, where we find NPV 0 is the IRR. Okay. So NPV project, net present value of projects, the NPV depends on cost of capital, as you see, cost of capital. And net present value profile graphs the NPV over a range of discount rates based on the data the NPV is positive and only when the discount rate are less than 14%. So if the cost of capital is less than 14%, we have NPV positive. We find the NPV positive. So, okay, determining cash flows, the cash outflow, make the investment, the cash inflow generated by the investment. Okay, so let's solve a problem. The following problem. Consider the following situation in which the financial manager must decide whether they acquire new equipment that cost 50,000 and requires outlay of 5,000 to install. Okay, 5,000 installation charge is current cash outflow and is also depreciated over the 5 years. Okay, estimated annual operating earnings generated by the equipment are 15,200 before the annual depreciation expense. This is the estimated annual operating earnings. Okay, cool. So in addition, the firm's investment inventory rises 2,000 and its account receivable increases 3,000. These increases in inventory and account receivables are cash outflows that require additional funds. And in the 5th year, the inventory and accounts receivable are restored to their current level, in other words, before the investment in equipment and the time the equipment is removed at the cost of 4,500. How can we find the cash flows? So, and the income tax rate is 20%. Okay, what are the earnings and the cash inflows, outflows generated by the investment? We have many data given, and let's put it in a table. So how can we determine the earnings? So it's given in the question. We have earnings before interest and tax, which was 17,200. Just we write year 1. They're same for year 1, 2, 3, 4, and 5. So we just year between 2 and 4 included, and year 5, 17,200. What is the depreciation amount? It says the depreciation, so it cash outflows and is also depreciated over the 5 years. Okay, this is the installation charge depreciated in 5 years, and also expense. Yes, and it's depreciated in 5 years. So we have 50,000 for new equipment, and we should depreciate the equipment straight line, and each year we depreciate 10,000, and at the end of the year 5 we have accumulated depreciation is 50,000. So for each year we write 10,000. And depreciation of installation expense, what was the installation expense? It was 5,000. We have 5 year. The total depreciation time is 5 year, and each year 1,000 depreciation for installation. Easy, we just write 1,000 for each year. This is between 2 and 4 included. For removal expense, at the end of 5th year, we have removal expense for the 5,000. Okay. What was the taxable income? We just subtract earnings before income and tax. This is positive, this is negative and negative. And 11, we subtract 11,000 from 17,200. So we find 6,200. Same for all of them, and we also subtract 4,500, and we find taxable income. Based on this taxable income, we are paying tax. The company pays tax. The tax ratio is 20%. So 6,200 multiply 20%, multiply 20%, multiply 20%, 20%. So we find taxes. So we subtract taxable income. This is plus. We subtract taxable income minus tax, so we find net income. This is the line we want to compute. This is the line we want to calculate. So what is the cash flows? Cash flows, in order to find the cash flows, we look at the net income, and we need to add depreciation, because depreciation in the previous part, this is not a this is just expense we need to incur, but this is not an actual cash flow, so we need to add the cash flow, add the depreciation amount to income. So this is plus, this is plus, this is plus, so we add depreciation for income. Again, depreciation of installation expense, this is just an expense, not a cash flow for the abstracted from the earnings. We need to add depreciation plus, right, change in the inventory and account receivable. So in the first year, as you remember, the company increased inventory and account receivable, which is, if the company just increases inventory, this is cash outflow, and also account receivable, same, this is cash outflow. And the total change in inventory and account receivable is 5,000, so this is negative impact for our cash flow. So simply we sum three figures and subtract 5,000, and we find 10,960. Same for here and same for here, and we find cash flow for each year. Okay, given information in the last example, if the initial cost of the investment is 60,000 and cost of capital for the firm is 7%, should the firm make the investment? As we already calculate cash flows, right, for 5 years, and we have the initial cost, like time 0, time 1, time 2, time 3, time 4, time 5. Okay, and in time 0, the investment is 60,000. In time 1, what is the cash flow? Cash flow, we need to find the cash flow. Okay, the cash flow is 960. What is the cash flow for the, for 3 years? 1596, I guess, right? Yeah, and 15,960. Same, 15,960. And for the 5th year, 17. Okay, so simply we have cash flow for each year. We need to find the present value of these cash flows. Remember, what was the net present value? The net present value is the present value of benefit minus present value of cost. So let me delete here. So simply we find the cash flows. So this is present value times 0. We find present value of cash flow 1, present value of cash flow 2, 3, 4, and 5. What is the present value of cash flow 1? Okay, cash flow 1 over 1 plus, what is the capital, the cost of capital? 7%. 7%, 1. What is the discounted cash flow for time 2? Same, we write cash flow of 2 over 1 plus 0.07 power of 2, and we calculate all the cash flows for the time 1 and between time 1 and time 5. And we just subtract, add up all the cash flows and subtract the 60,000 and find net present value. Let me clean here. So we find this is the net present value of cash flow 1 over 1, 7 plus cash flow 2 over 1 and 5th year. and we have present value of cost. When you add up, we find net present value is 1700, almost 1700. So how can we calculate in financial calculator? Just use your financial calculator and push bottom of cash flow CF and to enter the cash flow of 0, negative 60,000. For cash flow 1, enter the values for cash flow 1, cash flow 2, cash flow 3, cash flow 4, cash flow 5. You will see these notations: cash flow 4, cash flow 5, and then find the NPV button. Just push the NPV button, and you will see the interest rate. Enter the interest rate 7, not the 0.7. No, don't write 0.07. Just write 7. That means this is 7%, and push the enter button, and then you will use the down arrow, and you will find NPV, and just find the compute button, plus just push compute button, and then push the NPV, and you will find the NPV, the NPV, which is 1,764. Okay, what is IRR? The rate which equates the present value of cash inflows and the cash outflows. Compare the rate to the cost of capital. Okay, so from the equation where NPV is 0, the cost should be equal to the discounted cash flows, and we calculate IRR. Again, we will use the financial calculator. You can find the IRR button in your financial calculator. So decision criteria is if IRR is greater than cost of capital. If we find some IRR ratio which is greater than cost of capital, we accept the investment. If internal rate of return is less than the cost of capital, we reject the investment. So ranking rule: when you have mutual exclusive projects, you pick the one with the highest IRR. Mutual exclusive means that acceptance of one automatically excludes the acceptance of the other. Let's solve another problem. Back to our fertilizer problem. Suppose that the cost of capital for the company is 10%. Okay, calculating IRR. Do you accept the project or reject the project? Again, we will enter the cash flow of 0, cash flow 1, 2, 3, 4 in our financial calculator, and then we calculate IRR, which is almost 14%, right? What was the cost of capital? Cost of IRR is 14%. What is the cost of capital? 10%. Should we accept or reject the project? Of course, we accept the project because IRR is greater than cost of capital. We accept the project. So net present value at 10% cost of capital, we find 7.2 million. We accept the project, and as you may remember, the figure that I showed you, this figure, the cost of capital was 14%. This is positive NPV. This is negative NPV area. So IRR is 14%, and we accept the project because IRR is greater than cost of capital. Okay, and difference between NPV and IRR. Okay, this is net present value. We have the present value of benefit minus present value of cost. This is net present value. As you see, we discount the benefits to time 0, and we have cost, present value of cost, so we find net present value. What is IRR? IRR is, we just in order to find the internal rate of return, we say NPV, we equate NPV is 0. So if NPV is 0, then we can find IRR, and cost of capital is equals to discounted cash flows, the sum of discounted cash flows. So you see, we just manipulate the equation. Now in IRR, NPV is 0, and we just put the C here and say C is the cost of the investment, the present value of the present value of cost should equal the cash flow, discounted cash flows, the summation of discounted cash flows. So this R gives us IRR. We're trying to find here the R is equals IRR. R is equals IRR. Okay, let me write here. R equals IRR when NPV equals 0. Okay. So both techniques use the same data. Okay, NPV discount at the cost of capital to determine the NPV. IRR determines the investment's return and compares the return to cost of capital. Yes. Let's solve a problem 3. Assume that the firm has an opportunity to invest in a project which will give cash flow of 500, 200, 400, 700. And what is the investment? 1200. So we're looking at IRR. Okay, so in IRR, net present value is 0. What was the net present value? Net present value is the present value of benefits minus present value of costs. What is the present value of cost? 1200. What is the present value of benefits? This is at time 1, time 2, time 3, time 4. We need to find present value of these cash flows, right? And equate the discounted cash flows, the summation of discounted cash flows to 1200. Let's solve. So use your financial calculator and find the CF button in your financial calculator, and then first you can find the second, this is yellow button, second plus clear TVM, and second button plus clear work. That means you clear the previous entries, and then you find the CF button, click on push the CF button and enter the cash flow at time 0, 1, 2, 3, 4, and then find the IRR button in your financial calculator. And in order to compute IRR, you just first find the compute button and then push the IRR button, and you will find 16.87% IRR. Okay. Problem 4, Texas Instruments is considering between 2 mutually exclusive projects. The following table gives the cash flows of each project in millions. Project A, time 0, the cost of project is 55. For project B, the cost of project B is 130 millions, and time 1, this is cash flows for project A. This is the cash flow for project B. So we just compare NPV A and PV B. Right? Let me clear. If your discount rate is 10%, what is the NPV? Yeah, we should find NPV A for the project A, net present value for B. Okay, and what is the IRRs of 2 projects? And then this is the first one, and the second one, be looking for internal rate of return for project A and internal rate of return for project B. And based on these findings, we will decide which project is which project we will prefer to invest. Okay, let's look at the solution. For project A, we're investing 55 million for today, time 0, and the cash flows are 20, 25, 20, 15, and the summation of discounted cash flows plus the cost, present value of cost, we find NPV for project A is 9 million, and PV for project B is 21. So which project do you want to invest? The highest NPV is the better, and we will choose a 21 million. What if you look at the IRR? If you calculate IRR, you will find, so we're choosing by looking at NPV, project B. But if you look at the internal rate of return, the project A IRR is greater than, so higher than the project B. It's kind of weird. Why? Because why do these two rules give you conflict results? So based on our knowledge, we are saying that, hey, if the IRR, internal rate of return, is greater than cost of capital, which is 10, you should choose the project. Let's say IRR is 17.82. Based on IRR, we can choose project A because it's greater than 10%. Again, if you look at the internal rate of return for project B, which is again greater than 10% cost of capital, the both project is the both projects are preferable in the sense that both of them greater internal rate of return. But the most important part is you need to look at the NPV, and you should decide based on net present value. Based on net present value calculation, you will choose eventually project B because you will get highest net present value. Okay. So what is the IRR that equalizes two projects? So we find NPV for project A, but the R's represents here is IRR, and the calculation of NPV, net present value, for project B. So for the project B, we have 130 outflow in time 0, and this is the cash flows for 4 years. So the R represents IRR. So here the R represents IRRB. This R represents IRRA, right? So we're trying to find what are the values that equates these two equations, these two projects. So we find this, and then if IRR project A 14.74%, and if IRRB is 14.74%, then we will see the net present value A equals to net present value for project B. Okay. Oh, let's look at the graph. So when you see, okay, when you look at the NPV, net present value, in y-axis and in the x-axis we have internal rate of return. For project B, IRR is when the NPV is 0. NPV is 0 here. You will see project B is 16.88 and project B A is 17.82. What is the intersection between two projects? The intersection point is 14.74. Okay, and they have in the intersection they have positive NPV. Okay, so wrap up. We look at the finance diamond, and in this session, I explained the capital budgeting, net present value calculations, and the internal rate of return calculations, and we saw a couple of problems. So please review your notes, PowerPoint slides, chapter 13, 21, 22, and complete the mind type exercises, quizzes, video reviews, PowerPoints, and flashcards. And all questions will come from mind type exercises and quizzes, plus book exercises at the end of each chapter. And we have quiz 4 on Friday 26th, and we have final exam July 1st. Congratulations that you have completed all the course materials, and thank you for your attention.